Hello, my name is Brian Overby. I am the author of the Options Playbook and your host for Options Guide TV for about the next 30 minutes here. Today is Monday, February 26th. The markets are open and rocking and rolling. So, big news is we had the Walmart split, stock split, which we haven't had a split in quite some time. I think the last real big one was in Google, and that actually didn't work out too well for Google in that they did a split, and they're basically trading right where that split was almost a year and a half later. But the big thing in the Google space, and I also think this applies with Apple also, is they just haven't really came out and been a leader in the AI space. Out of the Meg 7, Google is one of, or Alphabet, I should say, otherwise known as Google, is one of the stocks that has the best PE, the best multiple out of the Meg 7. But the stock just can't get ahead of itself. And more people, I think, are worried about what AI might do to search and the fact that they're not really making any headwind in that space relative to companies like Microsoft that's in the search space, and that might actually pull away some of their monopoly that they have right now in search. So Walmart doing a split, interesting just because it's Walmart to want to have a lower stock price and dealing with lower prices and just the concept of who their client is. I can understand why they want to do the split, but I'm not going to go chasing this. A lot of people used to chase stock splits just to look for the bump up. Walmart right now is up about 1%, trading right at 59.16. And that underlying stock, if I don't want to, I don't mind the stock. They had decent earnings along with Home Depot and actually had a decent run up because of that. I just don't think that the concept of chasing stock splits is as hot as it used to be. There hasn't been as many, just overall. Okay, so that's all on Walmart. Now, on the underlying market, we've kind of got a little bit of a feeling for what's going on in the marketplace right now. The S&P 500 index is trading at 50.85, kind of flat. We did an Iron Condor a couple of weeks ago in the SPX that's expiring on March 1st. And we've had a little bit of volatility around the 5,000 level. And that was one of the things that we were kind of waiting to see. Was the 5,000 level going to act as a resistance to the down, or a support on the downside? It definitely broke out to the upside pretty aggressively around that level. So what we decided to do, because we usually look to try to do some type of paper trade around the SPX, around the index, more of a staple of the portfolio, then we're always looking at interesting earnings reports to do trades on. And Options Guide TV is all about learning, right? We're not always speculating in a real portfolio around earnings, but it gives you some ideas. If there's some stocks that you want to trade against, you really, these are some of the strategies that you can use. We looked at NVIDIA, we actually got bearish on, and the trade didn't work out on a speculative basis, but we talked about buying some protection on the downside because there was some nervousness going into NVIDIA's earnings only because of the big run up. And actually there was a fairly decent sell-off before their earnings announcement. That one didn't work out, but we also looked at one in Coinbase and talked about just getting bullish. Coinbase is an interesting way. The symbol is coin. That they have a solid management team that participates in the non-regular securities, cryptos, almost anything that doesn't trade on a normal exchange. Coinbase is trading in some way, shape, and form. And so when crypto goes up, usually the stock price will rise with it. They had a solid earnings report around that. And because of it, that stock is actually rocking and rolling to the upside right now. And we went in and entered a long call spread, a 50-50 trade. We basically bet 250 to try to make a total of 5, so 250 to make 250. on a long call spread, and that trade worked out. So today, what we're going to look at is our SPX Iron Condor that we put on. That was a little different. We've been doing all the way up to the 5,000 level. We were doing a lot of skip strike butterflies, and we missed out on a home run by literally one day. We almost hit it perfect where we were going to be at 5,000 right on that expiration day. It opened up the next morning at 5,005. Would have got out of the trade, would have had a good trade in general in the SPX butterflies. So that was a fun run. And that big round number of 5,000 is really what we're targeting. There's no rhyme or reason, kind of like a stock split, why 5,000 is a magic number and why people have a tendency to focus on it when they're looking at their charting. But that trade worked out for us, and it worked out for us about 5 weeks in a row. I'm going to go back to that trade again. We're going to do it on a Monday. A lot of times we establish it on a Friday, but today is Monday, and we already had an Iron Condor on that's working out. We may have adjusted it when the market went down, but I don't really think that we would have. It was a couple of weeks out. Right now, it's expiring on March 1st, and I'm going to run to the TradeHawk software right now, and we're going to look at that Iron Condor and talk about how we would adjust the trade and what we're going to look to do with that trade. So the Iron Condor that we did, if you see here, here's the SPX. It's at 50.81, and this is a trade that I may do on a monthly basis. Looking at the Iron Condor and where the markets are at right now, I kind of feel like we're a little bit more in the neutral marketplace. I didn't want to be in that Iron Condor in November and November, December, January, just because I felt like the markets were bullish. And we talked about that if you go all the way back to November, when we actually got long NVIDIA inside during the show on Options Guide TV. Just the market sentiment going into the end of the year had a bullish sentiment to it. So I don't want to be in Iron Condors at that point in time. I don't mind doing them now. And we put one on, and we're going to look at it and see how our concerns about the trade, how we're going to adjust the trade, and then we're going to look at an SPX skip strike butterfly once again and go back to the well and look at that trade, because I'm kind of feeling a little bit better about where the index is at and where the next steps are at. Okay, so let's look at that trade 50.81, and I'll say the trade out loud and then I'll set it up inside the TradeHawk software. But we sold on the call side of things, and that's where our risk is at. We sold the 51.25 call and we bought the 51.30 call. As I said, the market's at 50.81. And then on the put side of things, we sold the 49.15s and bought the 49.10s. Now, we did this about a week ago or so for $1.50 net credit to the account. So to start with, the downside, we have 1 week remaining. It is Monday, and I would definitely look to do this because we've had enough time decay in our put side of things that we might want to close out that side. And I definitely would want to do this. So I'm going to run all the way down to that put side, and that's where we're going to start. Now, this isn't the paper trading portfolio. That's inside the TradeHawk software. We have a paper trade portfolio, mostly deep into money call options, but that paper trading portfolio doesn't allow you to get quotes in the S&P 500 index, mainly because you have to pay for those quotes, and just there's not a need. It's a paper trading portfolio. So I get it. I get why the TradeHawk software does not have it. But with that said, we got to do everything in a live test account, and so I'm just going to act like I'm going to enter this trade today. We sold the 49.15, so here's where that is at. Now we got to look at buying to close it. This is the one we sold. So if we sold it, we have to buy it back. So we're going to pay the ask. And then on the low end, we bought the 49.10s. So we're going to have to sell and hit the bid on that. So right now that's trading for 7 cents. I'm fine with that. Anywhere a dime to a nickel, I'm going to buy that trade back at. If you want to mess around with it, you can try to put it in for 5 cents and see if you can get that execution at that point in time. Might have to do it actually in 5 cents or 10-cent increments. No, because it was trading at yeah, we're probably going to have to do a 5 cent increment. So let's do the midpoint right there. And that's how we would enter the trade. Now, notice there's still some juice in these option contracts. It's a tight bid-ask spread, but there's still some real premium in it. It's trading for the one that we are focused on. The one that brings us the risk is 130 by 135. So it's not like we're buying back zero options that don't have any probability of happening. If we look actually at the delta over here, we got a low probability. 0.03 is what the delta is at, so 3% chance of it happening. But with that said, I still want to buy this back. So we have Monday. We have too many trading days where the market could swing back and swing down. So whenever I look at this trade and I can close this out for a dime or a nickel, I'm going to do that. So we're going to enter that at 5 cents X, like that trade would fill. Probably would in the SPX. We remove that trade. Now we don't have to worry about it anymore. We did the entire trade for $1.50. So right now, the maximum we can make is $1.45. Okay. Now, if we get rid of this, so remember, we hit send on this. This is where we're at. We bought the close and sold the close. And now I'm going to remove that trade. And let's go back to the upside. Now, this is the side that we got to be concerned about. We sold the 125 and we bought the 130. So if we sold, well, I'm just going to put it in as the actual trade. So on this instance, we sold the 125 and we bought the 130. So this is what the initial trade was. We're not looking to close it. We're at 135 right now. So excuse me, I apologize for that. So with that said, we're fine on the trade. We would actually be up a nickel at this point in time. It is Monday. Monday and Tuesday on the Friday options are big days. We still got the chance to adjust them, but there's a lot of time decay going all the way up to that Wednesday. Well, let me say it this way. The options will have a tendency to hold some premium. I kind of said it backwards going into Wednesday, and then Thursday and Friday is when you get a lot of time decay in the SPX options. And it's mainly because it's just a real expensive index. It's a $5,083 index. The more expensive the index or the underlying stock, the more expensive the option contracts are in general. And so they have a tendency to hold their premium. You can talk about theoreticals, look at theta and say all this, but this is just real world stuff that I'm saying. So I can adjust this if I wanted to. This isn't a bad spot to adjust it. The 5,100 level, it would be kind of an area that I may be a little bit nervous about. Right now, just looking at what happened overnight and over the weekend, kind of feel like it's still a neutral marketplace. And the path of least resistance, if I had to guess, would be a little bit more to the downside. The overnight low in the futures was right around 50.87. We're below that mark at this point in time. I just kind of want to stay the course on this. If I were to roll, I would roll in the same area and we'd roll up and out. We'd roll not out, we'd roll up in strike price, buy this back, and do something right around a 1 standard deviation move. But that's going to cost you a little bit, and I really don't want to do that at this point in time. So we're going to let this trade ride, and we're going to watch it this week. And don't mind where we're at, 135, 140. We're profitable on the trade, but this is the dance that you do with the Iron Condors. Now, I mentioned at the very beginning of the trade, maybe you would have closed this out. And let me show you where. Okay, so we're going to go back a couple of weeks. Let me pull up the SPX chart and hope that we get there fast. We're going to also look at the IWM trade today. SPX. Okay, so this is where we actually saw the market come all the way down to this level. And when that happened, that was on the 21st. We are now on the 26th. So there may have been an opportunity. And I didn't, and honestly, because this is a paper trade, I wasn't watching on this day that where it got to. But the market up here is where we sold this at, right around here is where our strikes were. If we could have bought it back for 15, 20 cents, that's maybe an if. There was still a lot of time premium left in it. But yeah, then we would have traded this perfectly, right? Because you closed out the call side of things when you had that opportunity. And now that it's up and we got the last week to expiration, we're closed out the put side of things. So there was a chance, there wasn't an opportunity right around the 20-day moving average, which always noted that that always seems to be a support and resistance level in the S&P 500 index, right around that 20-day moving average. There's a lot of people that are looking at it. And we see that we kind of bounced off of that and we headed straight right back up. Okay, so moral to my story is if you're doing the iron condors and you have a chance to take off the risk, almost like if you're just doing short call spread, short put spreads, if you can get the bulk of the premium out of the trade and you can remove the risk, you want to do that. And so if that market comes on the downside, it just didn't happen to be on a day that uh, whenever this, when was the 21st? Yeah, I think that was a Thursday. It was a day that we didn't have Options Guide TV. But if there's not an opportunity to get out of that trade, and that opportunity arises, you take off that side, you leg out of it. I totally treat this as two different spreads. I don't just look at it, oh, let's put on the iron condor and let's just hope that it doesn't ever reach a strike price. We're going to try to manage the risk. And one of the best things that one of my favorite things to do in iron condors is to try to remove, just like our long straddle that we're going to talk about in IWM. You see an opportunity, you can remove that risk and you can do it and get the bulk of the credit on that put side or on that call side. You go ahead and do it. Okay, so that was kind of an opportunity, but we didn't talk about that. So to be fair, we missed out in that. We had the big gap up in the market then, right in this range, and now we got to be cognizant of our risk. If we break through the 5100 level, I'll be a little bit more nervous on this trade, but that level will scare me a little bit. This is the previous high, 5110. So, that's where we're at. I don't know how else to say it. We're going to be just watching the levels, and if we have to adjust, we'll adjust. All right. So IWM. Well, I guess we could stay in the SPX. Let's stay in the SPX. And we're going to look at our IWM trade at the very end here. Okay, so I do see that we do have a question available, and this is a great opportunity before we do the switch over to the SPX and look at our skip strike butterfly that we're going to set up for this week. Let's address any questions, and if you have any and you're in the YouTube platform, you throw them in the chat box. They're going to pop up here, and we'll share them with the rest of the group. So let's see the question. All right. I started watching for a few weeks. What do you suggest is the best zero DTE strategy? A short butterfly, short iron condor, or a short strangle? And when would you suggest doing it in the SPX or SPY? Now, as far as suggest doing it, hey, Wayne, thanks for the question. As far as suggesting doing it, there's no golden book of answers as to when I might look at the SPX and I might do one of these specific trades that were mentioned in the question. That's more about the feel of the marketplace and what's going on in the marketplace in general, just in general. Now, if I'm doing zero DTE options, I think I'm more apt to do something around the butterfly or even just a long call spread. So when we looked at some like Coinbase, for example, and NVIDIA, we were wrong on our earnings reports where we straddled the market and they announced earnings and the market skyrocketed. It was fine in my mind because in our paper trade portfolio, we were very long NVIDIA, and it was a big staple of that paper trading portfolio. So it was a short-term speculative trade. You could almost call it a hedge in my mind, but it didn't work out. The market went up, but the risk was limited. It was a 50-50 bet. You paid around, I think it was $2.40 to try to make $2.60, somewhere around that. In Coinbase, we did the opposite. We were bullish on Coinbase, and the earnings came out and the market went up, and you got paid right away. It was that simple. It was flipping a coin based off of their earnings to try to trade it. So if I'm doing a zero DTE, and I don't necessarily like these trades as much because I don't mind adjusting them, but they're simple, right? You put them on, either they work out or they don't. I don't mind looking at long call spreads and long put spreads where you center it around the actual underlying stock, like in the SPY. So if you have a way of looking at where the market's going to be at the end of the day, I would much rather do a long call spread in a zero DTE than just buying a call outright, mainly because then you take that time decay factor out of that position. And even in the SPY, it's a little bit, obviously a tenth of the value of the S&P 500 index or the SPX. It still has a lot of juice and a lot of premium, even on a zero DTE. So if I were to do a fancy trade, a three-legged trade, I would look at a butterfly. And if I'm trying to just go directionally, I'm looking at long call spreads and long put spreads. Those would be the way I would approach it. Okay, so SPX. So let's go back to the SPX. And this is our trade that we have on. So keep in mind that this strategy can kind of help us out, but we're going to stick with the 10-point wide iron butter or skip strike butterfly, and maybe, well, if I get time, I'll go back to it. I think I'm going to go a little bit long. I was thinking about running to the options playbook and showing you the skip strike butterfly, but we're going to stick here. We're going to remove this. Let's just get the trade set up, and we're going to stay in the same expiration. I want to be in the same expiration because it is a partial hedge. Now, I could do this as a one-off trade if I wanted to stick with our theme that we've been doing a weekly trade in the S&P 500 index. And in this instance, we're looking at about a 1 standard deviation move in the TradeHawk software. It highlights around where the 1 standard deviation move strike is at. It's always going to have a delta fairly close to 16. And it looks like that's where we're at right here. So we wipe this all out. Here's our butterfly. This will be our paper trade for this week in the S&P 500 index. We're going to buy this option contract. We're going to sell 2 of the 160s right here. We're going to skip the 170s and we're going to buy the 180s. And we're hoping we get this done for an okay net credit. All right, so 45, 55, let's call it 50 cents. It's bouncing all the way around. Market is now down a little bit. Kind of feel like the market's going to be a little bit more neutral today. So we're trading 50-cent net credit to the account. Skip strike butterfly. We're literally skipping the 170 strike, buying the 180. Once again, I like to call it a skip strike. People call it a modified butterfly or a broken wing. I like calling it the skip strike because we're literally skipping the strike. And by doing that, you're selling a credit spread right here. You're basically buying and selling that option contract, if you think of it that way, which embeds a credit spread into your butterfly, and that pays for the trade. So if I run to, where are we at? Let's run to the what if calculator, and let's look at how our profit and loss graph looks. Right, and we're going to zoom in on this trade. So 5180, talked about being neutral to bullish. The path of least resistance in my mind right now, I don't know why I struggled with that, is to the downside. If we put this trade on, we have our hedge at expiration. We have the butterfly. And to me, I like to look at it as we're selling a short spread, not that we're modifying a butterfly. We're selling a short spread and we're putting our hedge in the trade. And our hedge is the fact that we have this little peak right at expiration that can help us out. That's our hedge. So if I'm doing this trade, we're literally putting our adjustment into the trade before the trade happens. Think of it as a short spread that you bring in a nice net credit. We're going to take a little bit of that credit and we're going to buy these wings of this butterfly to try to help us out if the market goes against us. Now I'm going to zoom in. This is where the market is at. So we got a good solid move, right? One standard deviation move and then some to get to our risk. Almost a 2 standard deviation move to get all the way up to this range. And I'm going to take this and I'm going to zoom in. And we're just going to look at the profit and loss graph as expiration approaches. So now if we grab the calendar, it's highlighting that we're on Monday the 26th. So let's go to Wednesday. Let's go 2 days, all right? And if the market goes against us in 2 days and we're trading somewhere around the 51.35 level, we're down on that trade. And this trade is still hurting us at this point in time. And this is a big day. This Wednesday is the big day if you're doing a 5-day butterfly, 5 full trading days. This Wednesday is a big day because this is where time decay really starts to kick in. And then you go to Thursday. Now the graph looks a little better. And this is in theory. I feel like in the real world, it's a little bit more clear, but this is where the graph really starts to take off. Now, this is at this time, okay? So notice that the P&L calculator in the TradeHawk software has the time in with the calendar. So there is a day and a half left of time decay, right? So now we're going to go to Friday. And now we really like this trade, right? Anywhere in this range from 51.35 all the way up to here. And then you got half a day. And in that half a day, this line has to morph into that. So you put the trade on. It's very non-committal as to if you want the market to go up or down. Ideally, if we put the trade on today and it went down, that would actually be beneficial. We did it for a 50-cent net credit to the account. It would be actually trading for less than that 50-cent credit. It would cost us less to make the money back. So if the market went down to start, we would actually be profitable on that trade. And then but ideally what we really want, let's go all the way back to the beginning. Isn't that the right day? Yeah, we'll let it go. I don't know what I did. But if you go all the way back to the beginning, ideally what you want to happen is the market to make half of the distance, like get halfway to the expected move and get there by Wednesday. That's the ideal scenario. And then you're just sitting in the catbird seat and kind of hoping that it continues on up. But you also know that if it goes down or it stays flat, you still make 50 cents on your $1,000 investment. Now, I should highlight that the fact that we're embedding this credit spread from 51.70, that's where our risk kicks in. If we were in the short spread to 51.90, that's $1,000 requirement that you're going to have to put up front. So that's your risk in the brokerage firm. If they're doing risk-based margin, that risk is from 51.10 to 51.80. And so that $1,000 is on a 1x2x1. That's the margin requirement that you have to put up on that trade. All right. And if I look at any comments, we're good. We're solid. All right. So that's the S&P 500 index. If we get to the very end here, we're at max. Okay. So we're trying to keep the show about a half hour. I don't want to get too long-winded, but I can talk about options all day long. Now let's just look at IWM. Okay. We looked at a long straddle. If I'm looking at a long straddle in IWM, the market was at 197.42. It's at 102.201. It also expires on March 1st. Now, here's the other great example, just like we were talking about in the Iron Condor. This is the opposite. You want the market to move. If you get that chance where it moves and it pays for the trade, you want to get out of it. So this one is more important that you've had 2 opportunities on the upside. So this trade was put on about when the Iron Condor was put on. And I'm going to zoom in here and we're going to look at these 2 candles. Okay. This is the high. So let's zoom right there. Okay. So since we put the trade on, right around here, right in this area, 197, right in that range. Okay, so we paid 740 for it. That was for the call, and that was for the put. So we bought a long call, we bought a long put at 197.42. Somewhere, it could have been anywhere in one of these days. I don't know the exact day. Since then, you had the market run up to 203.50, and on the high here, 204. So 197 plus 7 is 204. So the market has gone on the call side of things the intrinsic value of the entire trade. Now, there would have been some juice in it, and you also would have still had the put. So the call at if you missed it on this one and it came up here and you said, oh, I think it's still going to run, and it comes back down, you would have been like, oh, panic mode. I'm all the way back down below. This trade isn't working out. And then all of a sudden, boom, you had the chance again. And if you didn't get out on one of these 2 days on the call side of things, well, then I guess I would even say, I guess I would give the stupid award. All right. If you didn't get out, you already had one opportunity that it came up, and if you didn't take the trade off here and it came all the way back down, you got another opportunity to take the call side off for at least 10 or maybe even $11. Then yeah, you get the stupid award for that trade. And now we're back to a level where it's not really panning out. And I still have the put side of things. If I did the call side, there would have been an opportunity to sell the put side and be profitable right here, right at the 197.50. So you still would have had that opportunity. I might have still stuck in the put side on here and seen if we would have broke down back into this channel. So I don't mind that at all. But you take that profit when it's available to you. If you can get one side of the long straddle to be profitable on that straddle. In other words, we put it, and this is a great, and this would be a great range, right? We put it on for $7.40. Probably right here, we could have sold it for around $10 or $11. Just the call for about $10 or $11. That would have left the put, and then hopefully we could leg out of the put. And so if we go back and look at this trade, and we're going to call it a day, this will be the end of it. 197. We're still in the March 1st expiration. Why did this move? Okay, so here's our ask is still on the call side. We're trading for $4.80. On the put side, we got an ask of 81 cents. So it's $4.81 at this point in time. If you're in, I would definitely, I don't know what the answer is here. I guess I would sell the call right now. You're going to, by Wednesday, you want to get out. Once again, the last 2 days are going to be a big time decay day. It's a $200 index, but I would think about just selling the call if I didn't take my opportunity at that point in time. A weird thing that you could do is you could go here, markets at 201. You could sell something like the 204, try to bring in a little bit of premium. Or I guess I would sell maybe right here, maybe bring in $2. No, $2.14. Maybe bring in $2 here is where I might think about selling this and creating a long call spread. But now you're just getting too fancy, right? You're just you're adding a level of difficulty that I don't think I would have wanted. So in here, IWM, we've done a couple of long straddles. This one you would have had to trade a little bit, but I still think it's an interesting trade. IWM is very interesting right around this level. Side if it wants to break out and continue on up, or break back down into its long established channel. Russell 2000 index doesn't always work out exact. It's a tough one to chart. We had that real strong breakout, really thought it was going to keep going, and it didn't. But this opportunity definitely would have worked out if you would have managed that trade. Okay, that's it for this edition of Options Guy TV. We'll be back. We'll be back on Wednesday and look at where our Iron Condor is at, and see if we have to make an adjustment in our short call side of things, because we got out of the put side. And then we'll come back and also look at where our new of this week paper trade skip strike butterfly is at in the SPX. Thanks for coming, everyone, and we will see you this Wednesday.